This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 325. A long way from a Minsky moment.
You buy long-term securities, you drive up their price, you drive down their yield.
My colleagues and I are acutely aware that high inflation imposes significant hardship.
The stock market is doing extremely well, which means to me jobs.
Because we inherited a bunch of formulas from the Labour Party that shoved all the funding into deprived urban areas.
All of their red ink is really our black ink.
This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
Well, the world really is now in the grips of an economic downturn, isn't it? Inflation is rising more and more, wages aren't keeping up, and in the UK, just for good measure, the government is making cutbacks as well. Where does it all end? Well, during the last global financial crisis, people started revisiting the work of Hyman Minsky. Would he help us now? And what did he stand for? What is a Minsky moment, and when will we next see one? We're a long way from it now, I think. So how different would the situation be now if Minsky's views had been more accepted? That's today on the Debunking Economics Podcast. Well, you've probably heard the expression, the Minsky moment. In fact, if you're a keen follower of Steve's work, you'll know that Hyman Minsky has been pretty influential in Steve's thinking as well. Even Janet Yellen, Steve, said at the onset of the global financial crisis in 2007 and 2008, she was the chair of the San Francisco Fed then, obviously destined for greater things and to become the Fed's governor. She gave a speech to the Levy Economics Institute in New York, which is where Minsky studied. And she gave a speech called A Minsky Meltdown, Lessons for Central Bankers. She said, that there was a lot to be learned from Minsky. Did she learn anything from Minsky?
No, and this is one of the. People. It just amuses me when I see stuff like this because, people say,
I love the way you laugh. It's like we all have to follow on what's going on in your mind. You're just laughing.
It is because,
Steve has amused himself already.
Okay, the reason I'm amused is that she spoke, and give Janet credit for this. The Levy Institute is a centre of non-orthodox thought in economics. The history of it goes back to the Levy family, who were tailors in the 1800s and 1900s. And I've forgotten which particular member of the family, but one of them was trained as an engineer. And he did his mathematics. In engineering, you learn all thing about sine waves, cosine waves, dampening, Fourier transforms, all this sort of stuff. And as part of it, he looked at the cycles that occurred in the prices of textiles. And he saw that there were these booms and busts in the price of textiles. And he was actually asked by one of his suppliers, look, there's a boom, prices are going up, you want to buy, and how much do you want to buy? He said, none. What? You don't want to buy any textiles?
Yeah,
it's going to get more expensive. Right. He said, no.
Because he knew that they were going to come down.
He knew they were going to come down. So they came down like crazy, and all of a sudden he bought it dirt cheap, and a lot of the firms were going bankrupt. So he bought this, not just their cotton stocks, he bought their machinery as well. And the family made a fortune.
But was that such a big revelation at the time? Because the idea of business cycles has been around for a long time, hasn't it?
People don't look back. The one thing we learn from history, we don't learn from history, okay? But if you do a mathematical analysis of it and find that there are these cycles there, which an engineer would do, then he spotted there are booms and busts. When this rising price period is going on, it's followed X months later, roughly, by a serious downturn. I'll buy in the downturn. Right. So he held his nerve. Everybody was saying, you got to buy now. It's getting more expensive and more expensive. Everybody extrapolates prices forward in infinite rise. Just like our Bitcoin friends have done recently. Yeah. Okay, so he saw this downturn coming, and that made him very amenable to non-orthodox economic thinking because all the other stuff was pushing in a different direction. So he heard of Koleski, and Koleski is the Polish Michał Koleski, I hope pronouncing his name roughly correctly. He was the Polish engineer trained in Marx's economics because he was in Poland under the Soviet Union. He was pre the Soviet takeover, but he nonetheless had exposure to Marx and. Anyway, so he also applied his same engineering thought, and then that became something that the Levy Institute liked, and that was also part of the inspiration for Minsky. Right. So that's the strong background non-orthodox economics, but with an engineering flavour.
Right.
That's the Levy Institute. Now, Janet, okay, give her credit. She did turn up once and gave a speech about how fantastic all these derivatives were because they were going to distribute risk and therefore eliminate it. And so the speech you're talking about is a second speech to Levy. She came along and said, "Oh dear, I got that wrong, didn't I?"
Right.
But give her credit again on that front, okay. But she has a reference to Minsky. So I, typical me, I go and read the paper and, don't remember a paper from that date. Went looking at the Minsky reference she has in her bibliography. It's a working paper that you can find in the Levy Institute archives if you dig really hard, but it's not something that was ever published. So I think what happened was Janet would have told one of her staff, "I need a reference for Minsky, give me a reference for Minsky," and this staff member happened to have a copy of that working paper, and that's what's put in her list of bibliographies. I doubt that she read it. And I read it, and it wasn't one of his better papers anyway.
Right.
So the extent to which she actually learned from Minsky, I think, is pretty close to zero.
Right.
But the terms become part of the language.
Right. But the top level, I mean, which is probably just, hair level of understanding, in the most simple form, is this idea that if anything keeps on, if you keep on buying stuff and the price keeps on going up, at some point you're going to see a crash. That we are. No,
that's Minsky's thinking. Is not mainstream. The mainstream things will reach equilibrium. I mean, you read.
But isn't it in a way equilibrium that if prices rise and then they crash and then they rise again, you are sort of like a waveform over an equilibrium?
You can be miles away from the equilibrium and always away from it. That's one reason I like people to take a look at the Lorenz attractor, which is the model of the dynamics of the weather system, an incredibly simplified model. But that gives you permanent cycles. And when you do the mathematics on the model, it has three equilibria, all of which are unstable for parameter values that are realistic for simulating basically the dynamics you see when you put a pot of soup on a stove and raise the temperature sufficiently, then the patterns you will see in the movement of the fluid, like on an XY, if you sort of look at it like an XY diagram of your stove and where's the particle of water going to be, then this is the route it's going to follow, and it will never reach the equilibrium. So if you're thinking and saying everything assumes going to get to equilibrium, you're in the wrong planet. Okay, and unfortunately, that's why the mainstream has never been able to absorb.
In that case, it's moving around the equilibrium, but I guess it's been contained by the container it's in. I guess
if you do a simulation of the Lorenz model, if there's a model of somewhere on the Patreon website, you'll find several copies of the Lorenz model done in Minsky, my software package Minsky, and the defined areas of complete vacancy of space in the phase diagram are the locations of the three equilibria.
But if you were a believer in, the economy is in or around an equilibrium, then if you saw prices for assets increasing, you would assume, wouldn't you, by your own acceptance of equilibrium, that they are going to come down again because they're moving away from the equilibrium. So they've got to adjust themselves and come down again. So if you were a believer in equilibriums, you believe in the cycles, wouldn't you?
Your lack of training in economics is showing you, lucky man, because that is implying a cyclical path to an equilibrium.
Yeah.
When you look at how the neoclassicals think about it, we go back to Minsky because we're talking much about neoclassicals and why they can't understand Minsky. But their vision of the core model they use these days is called the Ramsey growth model. And Ramsey, a polymath called Ramsey, Frank Ramsey, invented this at the age of about 22, and he died in his late 20s. Published a paper back in 1928. He was somebody Keynes was not. He was called a protege of Keynes, but Keynes was blown away by his intelligence. He really was a hyper intelligent individual. So he built an elaborate model of what is the ideal savings rate for an economy. Is there an ideal amount that economies should save? And he's working all from the whole neoclassical thing where savings causes investments and all this sort of stuff. But it was an elaborate mathematical model, and the punchline for it is that the equilibrium of the model was unstable. Okay? It's got a saddle node. If you imagine I gave you a challenge of throwing a pea onto three objects, and you would win a prize if the pea settled in the equilibrium of the object. One is an upside down hat. Okay, that's pretty easy.
Yeah.
One is a cone pointing the other way. Forget it. You've got to get it right on the point of the cone. The third is a saddle. a horse's saddle. So if you imagine a saddle, it is feasible. If you get incredible accuracy, you can throw a ball bearing at a saddle and it lands right on the horse's spine and rocks up and down and slowly reaches and settles right in the middle where your ass goes as a rider. But the reason your ass can go there as a rider is it's unstable in the other direction. Your legs hang over the rest of the horse. So that's the shape of the equilibria for the Ramsey model. It's a saddle. And that is, mathematicians describe that as an unstable system for obvious bloody reasons. Okay. What economists did is say, oh, that's the equilibrium. Way in the future.
Right.
And he literally called it a bliss point.
So you either hit it and stay there, or you'll never get there.
Yeah. So what you've got to do to actually get you can, like, if you mentioned with a saddle, you can actually draw two lines expressing what the dynamics are. One is a line along the spine of the horse, and those are two arrows pointing at each other.
Yeah.
So if you jump on that axis,
right,
then you'll end up there.
You'll stay.
The other ones are pointing away. Okay.
Yeah.
So you cannot at all allow yourself to get even a minuscule amount off the others.
Right.
So that's simple. What we simply assume is you're infinitely intelligent. Everybody else is also infinitely intelligent. We all know the future. What's the future anyway, between friends? And so you work out where the saddle is, and then to move where you are, to reach the saddle, to hit the saddle, you've got to move from where you are now, which is an unstable point. You're saving too much. You're not spending enough, for example. So you've got to jump. Your consumption has to be a jump variable. And you jump from where you are instantly to land on that arrow pointing toward, and then you throw your ball bearing.
Right.
Now, that's their explanation for the trade cycle, is those jumps.
Right. So how
can anybody reading that understand anything sensible? Okay.
And who was it who was saying this? Who was
Ramsey back in the? But he was doing it in the vision his vision was of a single central planner working out the ideal savings rate for a whole society, and then and therefore, if you were not there, you have to move to this equilibrium vector, and then you can travel along that vector over time.
And I'm losing track now. How did we get to him when we were talking about Minsky? What was
because Ramsey's growth model is what the neoclassicals use these days,
right.
And that has an unstable element to it. But rather than saying, oh dear, because the equilibrium is unstable, therefore the dynamics will be oscillatory around the equilibrium, or you'll have to have you expect your price transactions to occur away from the equilibrium. They simply assume we're all hyper-intelligent individuals, all of whom know the future, and can therefore predict where the saddle's going to be when it moves and jump instantly to that point. And that's what's called the real business cycle explanation for business cycles.
Right.
So they have no effing way of understanding an unstable equilibrium.
Right.
So this has been a long diversion here. But that's why when somebody like Janet Yellen tries to read Minsky, they try to shoehorn him into that way of thinking, and they fail.
So Minsky's hypothesis, and am I oversimplifying? Because the way I look at this, as you say, as a non-economist, which is a very useful way of seeing the world, I just think if people have money and they think times are good, then they are probably going to spend a little bit too much.
Exactly.
And then they'll get to a point where they go, ooh, spend too much and I'm going to hold back. And so when you hold back, you're not spending, and probably that's going to catapult the same thinking in everybody else, because you're not buying from the person who is going to sell you stuff who has less money, and so you start this chain reaction. I mean, is that too simple? Am I explaining something?
There's a cartoon that has that sort of basis to it.
Right.
I found a little stock here that'll really excel. Somebody says, excel? Sell. and then finally there goes absolute mayhem, and finally the person who started says, I'm leaving here. Goodbye. Goodbye. Bye. Bye. Bye.
Well, that's it. The herd mentality, isn't it?
Yeah, and that is what actually goes. So neoclassicals, to try to hang on to the concept of equilibrium, invented the concept of rational expectations, where rational expectations mean the capacity to accurately predict the future. They abuse the English language.
Yeah.
If you took the definition and showed it to a sensible non-economist person, this is a definition. Somebody has a model in their mind which enables them to predict the future accurately. That's prophecy.
Right.
Oh, no, that's rational.
So that's why we all saw the 2000 crash,
the
dot-com bomb, and then the 2008 crisis. We saw all of that.
So Janet's one of the many who was, literally praising all the derivatives, all the, of CDOs and so on as a way of stabilising the market, distributing risk, and therefore we don't have to worry about it anymore.
That's why we all knew that straight after COVID we'd be hit with this rampant inflation. We all knew that was coming. I mean, everyone was talking about it at the time, weren't they?
Absolutely.
I mean, it's a voyage of discovery for everybody, isn't it?
It's a total voyage of discovery. So anyway, they can't understand Minsky's thinking. So Minsky's completely outside that tradition.
Right.
And if you go back and look where he came from, his parents were both, I think they met in Chicago, and they're both Russians, and they're both Mensheviks. So they were driven out of Russia by the Soviet takeover, by the Bolsheviks, because the Mensheviks thought you had to go through a capitalist period. So you had left-wing groups by sheer accident. The 1917 was an accident in many ways. Just the fact that the Communist Party came at the dominant group there was one of these quirks of history, but obviously it happened. So, but the people who got in charge were the Bolsheviks, and the Bolsheviks believed that you could jump over the capitalist phase and have a period of strong industrialization. The Mensheviks believed you had to go through the capitalist phase to get to the point where you could have a socialist revolution. So when the Bolsheviks won, one of the first groups on the extermination list were the Mensheviks.
Right.
Okay. So, and particularly when Stalin got in charge. So both Minsky's parents left Russia for America and met, in Chicago. So that's the background to him, his family background. I'll give it.
So he was very much a capitalist then in his thinking.
Well, it's complicated because the parents were both dedicated Marxists, but believed that you should go through the capitalist phase. So moving to America in that sense was a sensible move for them. They would have envisaged that ultimately America would become a socialist.
Right.
He really thinks this sounds weird, by the way.
Yeah.
Marx was wrong
Good luck
on
with
that point. We not need another talk on why Marx was wrong on that point. But anyway, that's the background. So he read Marx intensely as a child. And I know this from his own child because Alan Minsky, whom a very nice guy, Alan and his father had a sort of falling out one can have with a parent, and then they reconciled when Alan was in his 30s. And Alan went into media, alternate media, and then asked his dad one day, look, I want to learn about economics, where should I start? And he said, this is literally as he said it to me, Dad went into his studio, came out and gave me this, holding the book together and bent down to us and said, this is your first book. It was a copy of Das Kapital, Volume 1. Okay? So that's the background, intellectual background for Minsky. So when he came back from the Second World War, because his parents lived through the Great Depression and he was fought in the Second World War, American enlisted man, did a degree in mathematics. And then when he began doing his PhD, the question he asked himself was, and he put this beautifully in the book I recommend people should read on Minsky called Can It Happen Again?, which is a collection of essays. He said, can it happen again, it being a Great Depression? And if it can't happen, what is different about the financial system after the World War to what applied before the World War? He said, that is the question that to be seriously useful, economics has to answer that question. To answer that question, it is necessary to have a model in which a Great Depression is one of its possible states.
Right.
Okay. Now, that doesn't apply to the neoclassical world at all.
So that model is his financial instability hypothesis.
And
look, we'll talk about that because I feel like there's got to be a greater depth to that very
much more so.
Than I described. So let's look at the steps involved as he saw it in just a moment on the Debunking Economics podcast. I'm Phil Dobbie. He's Steve Keen. We are in the same studio today. I don't even notice a difference in sound. We're going to do that for the rest of this year at least, aren't we? So it's great to have you here. We'll be back in just a second.
This is the Debunking Economics podcast with Steve Keen and Phil Dobbie.
So, Steve, we've taken a while getting there, but we are talking about Hyman Minsky and the financial instability hypothesis. So, I mean, my very simple explanation was, yes, we stretch ourselves too far, and then a crash follows because we've overstretched ourselves. That's a very simplistic way. But is it accurate in its simplicity?
Pretty accurate. The simple vision that Minsky had was that rather than having what he called rational expectations, which is this neoclassical vision about a capacity to accurately predict the future of the economy and to jump onto the unstable path to reach it. He said we get euphoric expectations. And it was he said the natural starting point to analysing a cyclical economy is a period after a crisis. There's been a recent crisis, but the economy hasn't completely broken down. So you start from that point of view. Everybody remembers a past crisis. Everybody's conservative about the amount of debt they'll take on. So there's very little borrowing going on.
Yeah.
But then the people who do borrow money, because the economy hasn't completely crashed, the people who do borrow money with relatively safe margins are able to finance their investment. And then the leverage effect means, of course, that they come out ahead. So people start to look around and see that the people who are borrowing money now prospered. And quote unquote, this is a direct quote from Minsky, it pays to lever.
Yeah.
That starts. So people then start to borrow more money. Now, this is where the endogeneity of money, the fact that the banking sector creates money, is an essential part of his logic, though he never spelled it out in the same detail.
Did he recognise it, though?
He did recognise. He didn't do the same technical work that Basil Moore did, who's another recent deceased but wonderful post-Keynesian economist.
Because new listeners to the podcast might not get that, and we're actually going to talk about it in a couple of weeks about the fact that money is created by
bank lending.
Yeah.
But that was an essential part of Minsky's logic. He said, so for this to happen, there had to be a way that borrowed money can add to aggregate demand. And Minsky never worked it out logically. I managed to do that in about 2017, so I can prove that when you have a money system which creates money, rather than lending from Fred to Joe, which is the neoclassical loanable funds vision. When a bank lends money, it creates money. The borrower borrows not for the sheer pleasure of being in debt, but to spend.
Yeah.
So that adds to aggregate demand and aggregate income, and it hits asset markets as well. So that expansion of demand causes a boom.
Yeah.
So in that situation, everybody's starting to boom. The economies are looking fantastic. People are more and more willing to borrow money. But then the boom itself sets off changes in the distribution of income. Because
the rich are getting richer.
Rich are getting richer. The wage earners who are losing, like you had a downturn beforehand, so bargaining power drops, wages have been falling and so on. Now that there's a boom going on, the bargaining power of labour is increasing, wages are rising. You also have increasing...
Because you're getting to full employment, so people feel like they've got more of an ability
and
to
you've also
negotiate.
got, and this is important too in terms of another generalisation of the pricing dynamics, prices for ordinary commodities per unit costs fall as output rises.
Yeah.
Okay? That's the reality of that's real world statistics. You don't have diminishing marginal productivity and rising per unit cost. You've got falling marginal cost, and therefore as you get more and more sales, you're making more and more profit. Okay? So it's a very positive feedback at that stage. But it also, raw materials are necessary, and those raw materials are different. This is, again, part of Kolesky's thinking, which Minsky was aware of.
So this would be the case that if you use maybe 4 components to build a product, one and there's demand for that product, there might not be the same increase in demand for all of those 4 components. There might be a shortage of one of those elements.
You can't produce anything without energy.
Right.
So your energy costs are going to be rising. Okay. So your wage costs are starting to rise. Raw material prices, particularly energy, are going to start rising. And the third thing is because you borrowed money from the bankers, you're paying more money out to them as well.
Yeah.
Okay? So that means that when you get to the peak of the boom, the income levels people are expecting aren't there.
But it's not just going to be energy, is it? I mean, if there's other elements, because if you're saying, the
manufactured side will fall.
Yeah.
Okay, the raw material side of costs will rise.
Yeah.
Okay. So over given this, you can't produce my classic line about energy. Labour without energy is a corpse. Machinery without energy is a sculpture. So it's absolutely vital to have the energy side, and those prices rise. So all those rising prices redistribute income away from the capitalists, who are the ones borrowing the money, to workers, bankers and raw material suppliers. So the profit's not what they expect. So the willingness to invest declines. When it starts to decline, you borrow less money, so the credit-based demand starts to fall as well. And then the same positive process that got you there goes in a negative cascade. So you've got you're investing less. You're borrowing less, you're creating less money, the economy goes into a downturn. So you will come back down again, and that's the Minsky's explanation for a cycle is this phase of euphoric expectations, too much borrowing money, okay, and then you get to the peak, income distribution changes in ways you don't expect, you don't make the profit you need.
Yeah.
The first thing you've got to do is remain solvent, so you put all your money into servicing your debt. your consumption, your investment spending plunges. So investment goes from boom levels to crash levels, and you're back into the next cycle.
Yeah, and another way of simplifying an element of that, putting it into plain speak, which I've because I lived through the .com bomb,
of course,
where and I was working in that industry where everyone had hugely unrealistic expectations of how much they were going to earn, and even if there was an understanding about what the scale of the size of the market was going to be, everyone assumed that they were going to take a huge slice of it.
Yeah, that's right.
And of course, you couldn't do that, so companies started to fold because they just weren't getting the market share that they'd anticipated. And that happens, and that happened then because that was an extreme. But that happens all the time. Every company is expecting they're going to get more market share than there is a total market share available.
This is where you need to revise microeconomics, stay away from the garbage that neoclassicals do about rising marginal cost and falling marginal revenue, blah, blah, blah. Because what you're talking about is exactly the dynamic the real world has, which causes this instability. So because, let's say you're working for a little software company, I don't know, let's say a company, let's call it Imagineering.
Right.
Okay. And let's say the chief executive is a guy whose name is something really ridiculous. Nobody'd actually have this name. Let's say Jody Rich.
Right.
Okay.
Yeah.
And he might be backed by a couple of other weirdos like Jamie Packer, that sound right? And then who else can we throw into the mix? Oh, one of the Murdochs. Yeah.
Can we just say any examples given in this product? Entirely fictional. Any relationship, any relationship to people living or dead.
Living or dead
is entirely coincidence.
I'm terribly sorry for that, Jody and Jamie, and I wish we got one of the Murdochs. It was. I think it was Lachlan. Anyway, so they were expanding Imagineering, which was a software vendor, the dominant software vendor in Australia at the time in the 1990s. And because the market was growing so fast, they were expanding all their warehouses, expanding their retail outlets and so on. And they had, I think the expansion rate was 130% a year. Now, the thing is, they were doing it. Ashton Tate was doing it. Everybody was expanding because you all think you're going to get more of the market than everybody else. So you have overcapacity.
Yeah.
That also feeds into the whole cycle. And again, this is the change. When you flip your mind from the neoclassical vision to what Minsky was looking at, you might be looking at two different planets. So Minsky is describing the planet we're on.
And a lot of it seems very obvious, doesn't it?
It is very obvious,
but why? Because he wasn't really... I mean, the reason why people like Janet Yellen started to look at his work, well, apart from the fact that she'd been invited to talk at the institute where he studied, so maybe she felt like she had to pay some sort of homage to him.
Yeah.
But it was the crisis in 2008, which everyone was struggling to explain. So they sort of turned to Minsky for an explanation. Because he was, a bit like you and me, really, never really appreciated fully during his while he was alive. It was, posthumously, this podcast will be fascinating, absolute gold to everybody.
I should actually try to get a rational expectation for the gold delivered tomorrow so I can live well now.
There we are. There we are. So completely lost my train of thought now. I don't know how you do that to me. Anyway, what was the... So tell me about... I know the point I was trying to make. He wasn't appreciated, really, was he, when he was alive? And it wasn't until we hit a crisis then people started looking forward.
But again, what you find is they completely distort him. So they try to understand him within an equilibrium framework.
Like Janet Yellen was doing.
As Janet Yellen was doing. Yeah. And consequently, you don't learn the lessons because it simply can't be absorbed. So one of my best mates is a fellow radical from the student days of Sydney University, Rod O'Donnell, ended up also being a professor of economics. And Rod and I were speaking at a conference once in Canberra in the same session. And Rod said to the audience, look, I want to make a request of you. Please do not read Keynes. And I said, where's Rod going with this? And he said, because when you read him, you can't help but read him through a set of neoclassical glasses and you completely distort him. It'd be better off if you didn't even try to read him. Well, the same thing applies to Janet Yellen on Minsky.
Well, let me read something that she said, actually, because this was that speech that she gave in 2009. Because the question is, having, said that she's a big fan of Minsky and we should all go and reread Minsky or read Minsky for the first time, how should policymakers respond to bubbles, which is what she was concerned about. So she said that they have to be cautious. Central banks have to be cautious, of course. She said, is the threat so serious that a monetary response is imperative? It would make sense for monetary policymakers to intervene only if the fallout were likely to be quite severe and difficult to deal with after the fact. We know that the effects of booms and busts in asset prices sometimes show themselves with significant lags. In those cases, conventional policy approaches can be effective. For example, fluctuations in equity prices generally affect wealth and consumer demand quite gradually. a central bank may prefer to adjust short-term interest rates after the bubble burst to counter the depressing effects on demand. So I'm not quite sure what that's got to do with...
It's basically just saying I don't want to bother reading Minsky.
Okay, yeah.
Fundamentally, because again, the point that Minsky made about this, that you can't control these booms with interest rates,
right?
Because if you, and this goes back again to the same, Imagineering world you and I lived through in the 90s and early
because you can lower interest rates and think, if we lower interest rates, then people are going to borrow and invest. But if the economy is on a downturn, they're not going to.
They're going to borrow and gamble on asset prices rather than you cause asset price bubbles instead, which you're supposedly trying to prevent.
Yeah.
So, but Minsky's point was, if you have people who expect to make a 25% gain on their earnings, given the euphoric expectations at the peak of a boom, you've got to put interest rates up to 25 and 30% to stop them.
Yeah.
Now, there's no way they're going to do that. So what you find is that it is not the fine-tuning mechanism they think it is. And the reason this applies is because in their minds, and this is unfortunately you've got to look inside the mind of a neoclassical to know why we're in the cesspool we're in these days economically, they have the only determinant of the level of investment is the interest rate. The reason it's the only determinant is we assume rational expectations so people know the future. Okay, they've got their expected returns from all these various investments, and by putting up the interest rate, you reduce the net present value of those investments. So by simply raising interest rates, you reduce the number of investments that have a positive net present value, and therefore you reduce the level of investment. Now, Minsky's point was, if you're fiddling with something that's of the order of 5%, 10% rate, and you've got people expecting 25% rates of gain, no damn way they're going to worry much about the interest rate. It's their expectations that are uncertain. And they're not. You don't know the future. And this is where Keynes comes in so importantly as well. Minsky discovered Keynes late. Minsky had already built almost all of his hypotheses before he read the first work by Keynes. And he read, and this is a paper I recommend other people to read as well, a 1937 paper called The General Theory of Employment. Yeah, not the other Interest of Money. That's the book. Yeah. So he read it and he was in shock. Because he used to say, quite literally, one of Minsky's early papers said, if we make the Keynesian assumption that investment is controlled by the rate of interest and blah, blah, blah. Now, what it was actually was Hicksian assumption. It was John Hicks's total misinterpretation of Keynes that was seen as being Keynes. And then Minsky, by sheer accident, I don't know how he discovered the paper, read The General Theory of Employment, was blown away because all the stuff he was talking about, uncertain expectations, volatility and so on, was in that book. And in that, Keynes explained how people actually form their expectations of the future. He said, we don't know the future, it's uncertain. So you simply can't have a model that predicts the future. Even my Minsky models can't do that. But you start off, so you know it's uncertain. So what do? You fall back upon the wisdom of crowds, where others are likely to be better informed than you are. So you get a crowd effect. Yeah. Okay. And that's exactly what Minsky was talking about. And that's he named his first major book John Maynard Keynes, not because it was a biography of Keynes. It was in tribute to Keynes himself.
Right. We're going to talk about Keynes next week, by the way, on the podcast. So what can we're in an unusual set of circumstances right now. Yeah. Because of the pandemic, obviously stuffed things up, and we're in this unusual position where there's some people who do have quite a lot of money because they managed to stash it away because they couldn't spend it during the pandemic, which is a very unusual set of circumstances, and other people who are destitute right now, and then we've got governments trying to claw back money and probably doing precisely the wrong thing. Well, they're not probably, almost certainly doing precisely the wrong thing. So this is not the sort of downturn that Minsky would have foreseen. It doesn't sort of fit his model, does it?
No, it is different. I mean, there's a range of reasons. First of all, we had enormous demand stimulus out of government spending. Yeah. And if that hadn't occurred, we would be in the middle of a huge financial crisis right now. So I was advocating all the way through, government's got to put money in the hands of people who will go bankrupt if they don't have the money because they can't service their mortgage, can't pay their rent and so on. And even though it was done, grudgingly and badly and so on, it was done. There was a huge injection of government-created money to people's bank accounts. Then at the same time, they couldn't spend them on travel,
Yeah.
couldn't spend them on restaurants, etc., etc. So a lot of pent-up demand in that sense.
Yeah, so they gave too much. I mean, in hindsight, they gave.
There's no such thing. Hindsight, if you gave too little,
it would have been worse.
I don't want to know. I don't want to describe what if we gave nothing at all.
Well, it wasn't targeted enough. Let's put it that way.
It wasn't well targeted, but it was still there. So that's partly. You also had, of course, all the supply chain breakdowns coming out of COVID. Like we're still. I've forgotten another province of China apparently is going to lockdown right now.
Yeah, well,
China.
Guangzhou is till the weekend.
But also, of course, you've got to ship these goods, across oceans, and of course now you've got to, at least for a while, you had to give 2 weeks before you went on board the boat, 2 weeks after, and people's fews were getting sick on the way. All this stuff was meaning the cost of production is rising.
Yeah.
Okay? So that's a cause of inflation that, funnily enough, isn't part of conventional thinking. They think it's rising wages are causing inflation. Okay? Or government spending is causing inflation, but not rising costs.
Or there being too much money causing inflation.
Yeah, the usual that sort of stuff. But it's actually a rise in the cost of production. So, and also,
so where would we be then in Minsky's cycle in this, or we're just not on that? We're not.
Well, I think in that sense, because it's government spending avoided a gigantic crisis. So in that sense, Minsky would give a huge tick to what was done. As badly as it was done, a tick to the fact that it was done at all for that period. But then in the aftermath, you have increased cost of production, and there's not much you can do about it. What you have to do is prevent that, meaning that people who are at the bottom end of the income distribution can no longer afford basic necessities, which is what we're seeing. We're seeing riots in Germany, riots in France, riots in Italy right now.
Yeah.
They're much better at rioting than the British are, over the cost of living. Okay, and people refusing to pay electricity bills and gas bills and things of that nature because they simply can't afford to. Okay? So you don't want to have that situation happen, and then again you need government intervention to enable the poor to be able to pay those fundamental costs, because if your poor people can't afford to stay alive in your society, you're going to have a breakdown.
Here, people can't afford to use public transport to get to where the riots are. That's why it's not happening.
That's right.
Yeah.
Okay. Yeah,
so we're not on the cycle that Minsky was talking about, but to get back out, I'm just trying to figure out where would he see that we go next then? How would, even though, no one can predict the future, what would he be seeing? How do we get out of this?
I think, again, you've got to get government spending to make it possible for people at the bottom of the income distribution to pay for the absolute necessities of life.
Yeah.
Okay. The rich don't need to worry about that because they're rich. Okay.
Yeah.
They've got enough cash for whatever.
But then you're going to add to the supply-demand imbalance, aren't you? And that there's going to be greater demand for goods that are just not being produced.
Most of the price now is going to energy producers. And we're now seeing some change in that supply dynamic. It may alter. I'm not going to.
So it might sort of sort itself out if we wait long enough. So long as we allow people to get through it.
You certainly shouldn't be targeting a 2% rate of inflation.
Yeah.
And this 2% rate of inflation stuff is another neoclassical fantasy. Came out of the work of John Taylor. And Taylor, the arch-conservative neoclassical economist, did a sort of backtracking what has been the behaviour of central banks. And what he found was a simple rule that they had a 2% inflation rate target. And so that's simply what they were doing. So he wrote an equation where the number 2 actually turns up 3 times, quite strange, in the equation, saying that central banks should increase interest rates at twice the rate of the change of inflation, and that will stabilise around the 2% target. Now, it did actually describe what the central banks have been doing, roughly speaking, in past history. So it became taken as an immediate, sensible rule for central banks, and they built it into their dynamic stochastic general equilibrium models and so on. The Taylor rule is there. So they believe by varying the interest rate that they can control the rate of inflation. We're back in the mindset of a neoclassical economist. We're not on this planet. So the obsession with returning to that 2%, I think, is partly destructive. We could survive 5 and 6% inflation for a while.
Yeah.
Without. But if you
well, the point is it balances out anyway, doesn't it? It's like if something goes up by 5 or 6%, unless you're getting some sort of compound effect. I mean, it's like energy, for example, has shot up in price.
Yeah.
But if oil stays around $100, then the oil inflation next year would be zero.
Yeah, it becomes negative. That's what we're seeing in the numbers as well. But yeah, in terms of the fear has always been of a wage price spiral. And that's literally, if you look back at Phillips, who's somebody, again, people have completely distorted. He's another person we should devote a good podcast to. But in his original 1957 paper on how changes in money wages cause changes in price level, he gave three factors: the level of employment, the rate of change of unemployment, and cost of living pressures, leading to a wage price spiral. That's literally a quote. Wage price spiral is in Phillips.
Right.
Okay. No, and then people say Phillips didn't understand wage price spirals. Bloody hell, he invented the phrase.
Right.
But what that means at the moment, we look at inflation running at 9% and wages running at 6 or 4. You haven't
got that problem.
You haven't got that problem.
Exactly.
So,
and look, you're right, Philip. And I feel like we're embarking on a whole new podcast now. So we probably should use this opportunity to get out of here. But you're right. We should do Phillips on another one. I also was going to ask you, how Minsky built on the work of Irving Fisher as well. So maybe we give
Irving Fisher and Schumpeter. That's a good combination.
Yeah, so we'll look at that as well. We'll go through some of the. I think that's a good idea, isn't it? Over the next month or two, let's go through a few of these names and look at what they really stood for. And on that, next week, I want to talk about Keynes and what would if Keynes was alive now and he was a consultant to the government, and they were saying, "Oh, we don't know, what the hell should we do?" What would he suggest? We'll look at that next week.
That's going to twist my brain cells a bit, but I'll give it a try.
All right, great to have you in the studio.
Indeed,
Steve.
It's fantastic.
We'll talk to you next week.
The Debunking Economics Podcast.
If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.